Hey guys, we are here with the founder of Nexus Mutual, who will be doing a talk around learnings from the bZx Flash event and Black Thursday. And I'll let him take it from here.
I think we're good to go. Cool. Yeah, great to be here. My name's Hugh Carp. I'm the founder of Nexus Mutual, and here to just talk about what happened with the bZx Flash events and Black Thursday, and kind of how that plays into what Nexus is doing, and I guess what we can all kind of learn from that. A little bit of background on myself. I'm an insurance person by background. Been doing insurance for 15 years or so, before kind of diving into Ethereum about 3 years ago. Been an actuary by training and worked for big insurance companies, and including Munich Re, one of the biggest global reinsurers. So kind of know the capital side and the financial side of insurance and kind of how it all works. But trying to apply that to the DeFi and cryptos space with Nexus. So I guess the first thing is with insurance, and this often kind of happens, is you're all traveling along fine, as I guess most of us have been recently, and then something really odd happens, and it's a kind of, people think it's an extreme event, but I guess as humans we kind of often can't put a sufficient, it's hard to estimate how likely these things are, and kind of tail events, which we kind of treat them as, are actually a lot more common than we kind of intuitively think. So things like this often happen quite regularly, come out of supposedly left field, but when you look back on them, they're not that left field a lot of the time, and I guess it's often really hard to plan for this type of stuff. So I kind of think these are kind of two events and things that we should be thinking about, and hopefully can learn from in the future about how we design these systems and stuff like that. So diving into it, I'll dive into the bZx events first. So I guess the real background to this is that Flash loans were kind of newly created pretty recently, and that kind of the start of how these exploits kind of happen, but they're really kind of in some ways irrelevant. They just make it easier to exploit because people can have access to the capital they need to do these events. They're not necessarily required to execute these events. You could do it without a Flash loan. It just makes it more accessible for more people. So diving in, and big thanks to PeckShield's analysis for all this stuff. I've kind of, they've provided some really good summaries, so I kind of highlight those mainly. But just to give you an idea of what happened. So the first bZx events happened on Friday. I think it was Valentine's Day. And essentially, it's a whole bunch of complicated transactions all in one block. And it starts with borrowing a large amount of ether, and this one they took a bunch of ether from bZx to start with. Then they split that, put half of it in Compound, and put half of it in bZx. Sorry, can you not see the full screen? Hold on a sec. Hopefully that's a bit better. So the first, though I can't see the comments now. Hold on a minute. Might have to go back to this one because I can't see all the questions. And sorry, yeah, I just have to keep going. I'm not quite sure how to fix that one. Sorry. I can share the slides afterwards. Hold on a second. Yeah, so we started with grab the slides on the slideshow if you need them, and then so basically we've got a whole bunch of ETH. We've put half of it into Compound, and we've put half of it into bZx, and we've borrowed wrapped BTC from Compound. And then what we do in bZx is we create essentially a margin pump. So basically we leverage long on Ether and buying wrapped BTC. And because it relies on Kyber and Uniswap to do that, then essentially what happens is that it pushes the price of BTC really high. And so this one was important here because there's actually a check. There was actually supposed to be a check in the bZx smart contracts that that was effectively bypassed. It was a bug, and it shouldn't have allowed that kind of margin loan in bZx to kind of continue at that rate, because it effectively ended up in an under collateralized position. So therefore, what we've done here effectively is pushed up the BTC price 3 times. And then with the borrowed BTC from Compound, we effectively dump that into Uniswap and get a whole bunch of Ether. And we use that to effectively pay back the loan. And effectively what we've done here is left an underwater loan in bZx, and we've collected a whole bunch of Ether, paid back the flash loan, and we're about 350,000 USD ahead, all in one transaction. And so the key two real things here: one, there was a bug in the bZx smart contracts that shouldn't have allowed that position to happen. The check was supposed to trigger, but it was not coded quite right, and it missed it. And the second thing is that effectively, because bZx relies on Kyber and Uniswap by a certain amount for the price oracles, it kind of can cause some issues. So then, in summary, I think it was important that, like, in the first kind of day or so, everyone was talking about being an oracle attack, but this one wasn't really an oracle attack. It was really arbitrage and exploiting a bug in the bZx smart contract. So yeah, the oracle thing, which everyone thought it was to start with, was not kind of really the crux of this attack. So then 2 days later, a second event happened, and this was more like an oracle attack, and it basically starts in a similar fashion. You take a flash loan of ETH, this time from bZx. Then what they do is pump up the synthetics USD price on Kyber by selling ETH for the SUSD, and then so you've pushed the price up quite high because it's got relatively low liquidity. And then what you can do is start using a whole bunch of the other ETH. So you've only used a small amount of the ETH to push up the USD price quite a lot. But then you can buy SUSD at market price from the synthetics depot, and you can stick that SUSD in bZx, borrow some ETH at a silly price because it uses Kyber and Kyber Uniswap for the price oracle, which you've essentially manipulated, and then you can repay the flash loan at that point and profit by over 2,000 ETH. So the crux of it here is that you've manipulated the price oracle, and we're able to borrow at silly prices. And once again, it's left an underwater loan in bZx. So no one in bZx was actually directly impacted, as in they didn't like kind of lose the money that they'd put in, but it's kind of like it's kind of socialized the loss and pushed it off into the future. So someone effectively has to pay for it at some point in time, and so that's kind of common across both of these flash events. So yeah, in summary, this one is a bit different from the first one. It is indeed an oracle attack, basically, pushing the Kyber Uniswap price. So going on to Nexus Mutual. So this was kind of the first kind of claim event for us. I guess a really interesting time for us. Obviously, there's bad stuff going on with potentially people losing money, but from our perspective, it was kind of really positive because we were testing out our system. And so basically what happened in the end were the claims for the first event were paid. Once the bug exploit was confirmed, we actually declined the first claim because that was submitted like very soon after the event and not all the information was available to hand. But the cover holder was able to submit a secondary claim, and that was approved. So we paid claims for the first event, and the claims for the second event were denied because there was no bug exploit, and essentially smart contract cover covers against bugs in Solidity code, essentially, rather than things outside the system. So that's kind of where we ended up. Paid our first claims, which was great. Tested all kind of aspects of the claim system, and I think it was important from our perspective was these were quite technical claims and events about details about what was happening, but all of the claims were were kind of very like 99%. Everyone voted in one direction or the other, depending on if it was accepted or denied. So there was very strong agreement by the claims assessors as to what was a claim and what wasn't a claim, which is very helpful in kind of setting precedent for the future. So in terms of learnings out of this one, smart contract security is hard. Yep, it's going to continue to be hard, and things are getting better. But other things can come out of left field, like your threat model doesn't include necessarily flash loans. And I guess the other thing is assume any outside inputs. When you're designing these systems, assume outside inputs like oracles or whatever can behave maliciously and just won't work at some point. And what happens then, and how would it react? So when you're designing these systems, think in a very adversarial context. Yeah, and I guess the other point is everything is really, really hyper-connected. And I mean, as DeFi grows and as the systems grows, more and more, I guess, protocols are connecting with each other, and new stuff comes along, like flash loans. I mean, this could have happened without a flash loan, but I guess flash loans just made it much more likely to occur. And so events that could have been sitting under the radar kind of thing, or not being top of mind, suddenly can become a big issue just because of this connectedness. And from Nexus's point of view, the biggest thing that we learned was that wider risk coverage is important for user safety. And so it's not good if an insurance company doesn't pay claims when people just genuinely think that they should. And so we want to kind of increase the risk coverage and cover things like Oracle attacks and others, so that basically if you put your money in and get some cover, you're covered for whatever bad thing happens. We're not quite there yet, and it's kind of, there's some challenges about actually doing it, but that's definitely the direction we want to head, so that people can not be as worried when they're interacting with DeFi. So it's kind of the flash loan events. Black Thursday was kind of the next one. So very briefly, what happened? Basically 30% price drop in ETH over a very short period of time. And then in conjunction with that, because obviously that has implications for different protocols and things, the network just got massively congested and the gas prices went up. This is the average gas price on those 2 days. And it was going to well over 100, and I think it was up at 200 at some point. So you got a massively congested network. People can't get their transactions through, and people really want to get their transactions through because they want to pay off their loans that could quickly become under collateralized, or they're in a very time pressured environment. So these two things were the main cause of what happened with Maker. So effectively what happened is when the ETH price drops suddenly, or just when it drops, that triggers liquidations. But Maker has to know how, when to trigger those liquidations, so it uses an oracle. And the network congestion was so bad that it delayed the oracles from actually posting prices. So there was a bit of a delay there. And it also meant there was lots of liquidations triggered at once because it was such a big drop. And the other part here is that there are bots doing the liquidations that are set up, and they just set and forget type things, but they didn't automatically update their to respond to the higher gas prices. And so they weren't getting their transactions through to actually do these liquidations. And effectively what happened was that the maker system in a liquidation process requires auctions to happen to kind of get a fair market price for the collateral. And because of all these, I guess, correlated impacts happening at the same time, it meant that they were effectively uncompetitive auctions. And the ETH collateral was sold for virtually nothing because one person was able to get the transaction in there in a short auction window and no one else could because they didn't update their bots, or there was high network congestion, or just a combination of everything going on. And basically they just walked away with virtually free collateral. So the kind of smart contracts and everything worked as intended, but a whole bunch of other things happened outside the system that caused some issues, obviously. Just on Black Thursday, this is my, bit of a funny list, but this was my what was the unaffected list, Uniswap. Everything else pretty much, I mean, I'm sure there are some others, but pretty much everything else, every other protocol had to do something, whether it was changing risk parameters on some of the other lending protocols, or doing more stuff like Maker was. There had to be responses because this was kind of an extreme situation. But Uniswap just kept being Uniswap. Can't do anything with it. It's pure smart contract. Can't be upgraded. Doesn't really rely on outside inputs. So it just does its thing. So I guess the learnings from this situation were that if you're in extreme situations, generally lots of stuff's going wrong at the same time. So when we are designing these systems, we often go, okay, if something happens, if something bad happens, then we have to rely on something else to make it work. And so we can't do that fully automatically like a Uniswap. So we need to rely on a market mechanism, so an economic auction, or we assume some level of economic activity. And a lot of the times you kind of maybe assume that the markets will be competitive or liquid at all times, or sufficient to what you need it. But often in that extreme situation where you actually need the liquidity is not there. And so I think we need to be better at kind of threat modeling or scenario modeling, where we consider that, this particular situation occurs, what is the rest of the market likely to be doing at that point? And that means we may not be able to rely on liquidity, transactions going through, the network may be congested. Okay, so if under that kind of terrible scenario, how do we actually design a system that works and does what we need it to do? Mega had to jump in and kind of push some of the auctions to have some more time or delay them a few days, so that hopefully the network congestion had died down by then. So there's kind of we just need to be a bit more, get into the weeds on this stuff and work out when bad stuff happens, what's that situation likely to be like, and how can we respond in that, and how we can model it, and what should we do in response to that. So it's all about going to be developing more robust systems, because that's what we're all trying to do. And this isn't necessarily possible for every particular protocol, but be as much like Uniswap as you can. Don't rely on things. This is coming back to the kind of pure decentralization point. It's very robust and it's very strong, and it just kind of works. So that it's often very hard to create a product that is exactly like that. But I think we should continue to strive to move in that direction, because there are a lot of benefits, and that is one of the benefits of DeFi over regular financial world or CeFi. Systemic risk. So I guess I mentioned it a bit before, but we've got pictures pictures of the banks and systemic risk and connectivity between, if JP Morgan goes down, then Bank of America, Citibank, and HSBC, and all the rest of them are probably going to have problems because they're all kind of linked together in some way, and that's really, really hard to model. I actually think in DeFi, assuming we get to like really meaningful scale, then we're even going to be more connected than the regular financial world. The difference is that we've got the transparency to be able to monitor it properly, and we should be able to run detailed simulations and understand what could happen in bad situations to a much more specific and detailed level than you can do in the regular financial system. So, in the regular financial system, they all have to do, banks and everything have to do scenario testing and things, report to the regulator and do all that type of stuff. But often it's obviously within their own four walls, and so they don't necessarily consider all the interactions between everyone else at the same time. They try to, but it's often very hard. Whereas with DeFi, we can do that, and we can simulate everyone. All the data is there and available and transparent, and so we should be able to do that type of stuff. So that's one of the. We're going to be even more connected, so there's going to be potentially more systemic risk, but we can actually manage it, and so that's something to. That we really should strive for, and getting more kind of risk manager type people into DeFi is going to be important in the future. Yeah, and I've shown this one a bit before, but money. If we're doing money Legos and stuff, then we put a few together, and I start worrying. If you put even more together, then I'm right now at panic stage. But I think that's right now. One of the major benefits of Ethereum and DeFi and composability and stuff is being able to build new things really, really quickly and innovate. And that's really cool. And we shouldn't stop that. But we need to kind of do it in a risk-controlled way. Don't put too much money at risk. Start small. Work it out. See what works. Respond to what doesn't. But let's not. Let's not put millions and millions of dollars in stuff before we get more confident with it. So security focused first and foremost, I think, because if the better we can do this and better we can essentially self-regulate as an industry, the much better off we're going to be in the longer term. So, and hopefully, we can that panic, putting 6 DeFi Lego blocks together is not going to be a panic anymore. It can just be we should watch out for this. We should do some more detailed analysis. But it's okay because we've done a whole bunch of testing. So I think we're still really early. We're still finding our feet on stuff, but and we just need to be conscious of the risks that are out there and learn from them. I think so. This is kind of overall. I think we're actually quite lucky with these events. I mean, obviously some people have lost money and substantial money, and that's never good, but it could have been a lot worse. And so I think as long as we learn from this and harden systems and things and be more cautious, be more security focused, be more risk focused, then we're going to be in a much better place in the future. So yeah, that's a quick whiz through of what happened and what it means for Nexus. Hopefully we're going to be offering more comprehensive cover in the future and kind of reducing the levels of risk within the system overall. So yeah, that's it. Yeah, get in touch if you've got any questions. My email's there. You can look at the slides and stuff. But yeah, happy to answer any questions, which I think there are some down here. Make it our claims on Nexus. Yeah, so we actually declined the claims on MakerDAO because they were basically outside the terms and conditions, because it wasn't an issue with the smart contracts. It was an issue outside that. The smart contracts just worked as they were designed, but there was an auction failure and things like that. So yeah, that's kind of what happened with those ones. Data visualization was on slide 13. Yeah, good questions. Alethio Stats is kind of the DeFi one. You should check them out. They got some really good stuff there. I think that one was shared on social media, but there's lots of stuff lots of data that they've got that's really useful. Cool. Well, I think that's about it. So thanks everyone for listening. Hope you found it useful. Email me, Twitter, whatever. Happy to answer questions or jump into the Nexus Discord if you want to know more and see what we're doing and kind of how we can, I guess, help with this type of stuff as well. So yeah, thanks very much.
Awesome. We're going to transition to our next session now. Thanks so much.